Breaking news for investors. The Federal Reserve is about to speak, and the words they choose could shake financial markets worldwide. Most people focus on the obvious: interest rates, inflation, and unemployment numbers. But seasoned analysts know the real clues are hidden in plain sight. Subtle hints, careful wording, and even small changes in projections. These hidden signals reveal the Fed's true intentions, its view of the economy, and even how financial markets are likely to react. Today, we're uncovering 5 hidden signals that investors watch closely and why understanding them could give you a huge advantage. Signal 1. Tone of the Fed chair. The first signal is tone. The Fed chair's tone can indicate their confidence, caution, or concern. Every word, every pause, even emphasis is analyzed by traders. Words like gradual, cautious, or prepared signal a careful approach. Forceful language or urgency indicates potential rapid policy changes. Example: in 2021, when inflation started rising, Fed Chair Jerome Powell's repeated use of transitory pressures triggered a massive market response. Traders interpreted it as a signal that the Fed would delay tightening, which caused bond yields to fall and tech stocks to soar. Analysts even measure speech patterns, pitch, and pauses. A subtle hesitation before a phrase like "we may raise rates" can indicate internal debate within the Fed, a signal the public rarely sees. Actionable insight. For investors, paying attention to tone can help you anticipate market reactions before the headlines interpret the news. Signal 2. Economic forecast adjustments. The second hidden signal is changes in the Fed's economic forecasts. The Fed publishes updated predictions for GDP growth, inflation, and unemployment numbers. Analysts watch for even small adjustments because tiny changes can signal major shifts in policy. A 0.1% increase in inflation projections can spark speculation about rate hikes. Slight GDP downward revisions may indicate caution or concerns about slowing growth. Rising unemployment forecasts may suggest a slower recovery, influencing bond and stock markets. Example: in 2022, a minor increase in inflation forecasts triggered a surge in Treasury yields, causing a ripple effect across tech stocks and growth equities. Why it matters? By watching economic forecasts closely, investors can position themselves strategically, adjusting portfolios before the market reacts. Signal 3. Interest rate path hints. Third, analysts focus on hints about future interest rate movements. The Fed's dot plot showing each member's projected rate is crucial. Language in speeches like gradual increases or patience is a signal of whether rates may rise or remain steady. Example: if the Fed signals slower rate hikes than expected, growth stocks often rally, while financials may dip. Conversely, aggressive rate signals can trigger a market sell-off, particularly in sectors sensitive to borrowing costs. Pro tip: long-term investors can use these subtle hints to adjust portfolios for risk before volatility hits. Signal 4. Market reaction expectations. The fourth hidden signal is how the Fed expects markets to react. The Fed sometimes mentions financial stability, asset bubbles, or risk-taking. These statements help analysts gauge whether the Fed is concerned about overheating markets. Example: a warning about stock or housing bubbles can lead investors to rebalance portfolios, selling high-risk assets before losses occur. On the other hand, reassurances can trigger confidence buying, causing short-term rallies. Key takeaway: the Fed doesn't just set policy, it sends signals, and those who learn to read them gain a tremendous advantage. Signal 5. Subtle changes in Fed projections. The fifth signal is subtle shifts in the Fed's own projections over time. Analysts compare the current summary of economic projections to previous versions. Even minor changes can indicate major strategic shifts. Rising unemployment projections with persistent inflation might signal a shift in priorities, such as focusing on employment rather than inflation control. Changes in expected rate hikes indicate how aggressively the Fed might tighten monetary policy. Example: in 2019, subtle shifts in Fed projections signaled a pivot toward rate cuts, sparking immediate market reactions. Actionable insight: investors tracking these patterns can predict major market moves before the majority of the market reacts. Signal 6. Practical tips for investors. Here's how you can apply these insights. Read the transcripts. Don't rely on headlines. Subtle wording changes everything. Compare forecasts. Check GDP, unemployment, and inflation predictions against previous reports. Watch tone. Listen for confidence, caution, and pauses. Observe dot plots. They reveal expectations for rate paths. Follow market signals. Watch reactions in bonds, stocks, and interest-sensitive sectors. By paying attention to these details, you can anticipate market moves rather than react after the fact. The Fed doesn't just set policy, it sends signals, and those who learn to read them gain a tremendous advantage. Markets may move fast, but hidden signals exist for those who look carefully. Tone, projections, and subtle word choices can foreshadow major shifts in the economy. Stay alert, stay informed, and remember, the difference between reacting and predicting can be millions of dollars in wealth over time.